All right, let's jump into this deep dive. We're looking at sources about getting started with investing, stocks, mutual funds, stuff that can seem pretty complex.
Yeah, definitely. The material references things like market activity, even mentions places like Rajkot and big companies like Reliance or Infosys, so it's grounded.
Right, and it feels like investing has its own language sometimes. Our goal here is to sort of translate the key ideas from these sources for you.
Make it accessible.
Exactly. Make your money work smarter.
Yeah.
So first up, the stock market. The sources describe it basically as a huge online marketplace, right?
It's a good way to put it. It's where you can buy tiny pieces, shares, or stocks of companies.
And companies do this to raise money for growth and things.
Precisely. And for you, the investor, the idea, according to the sources, is you buy hoping the company does well and the share value goes up. Buy low, sell high. Simple concept.
But not always simple in practice. The sources are clear about volatility, the ups and downs.
Oh, absolutely. Risk is definitely part of the picture. And that's a perfect segue into why the material highlights mutual funds so much for beginners.
Okay, so how do they help with that volatility?
Well, think of it like this. The sources almost present it like a pre-made investment mix instead of you picking individual stocks.
Which is hard, let's be honest.
Very hard. With a mutual fund, you pool your money with lots of other people.
Okay.
And then a professional fund manager takes that pool and invests it for everyone. They choose a mix of assets. Could be stocks, maybe bonds.
Got it. And the big advantage mentioned everywhere in the material is diversification.
Yes, that's the key takeaway. It's the whole not putting all your eggs in one basket idea, but applied professionally.
So owning one mutual fund means you indirectly own bits of maybe dozens or even hundreds of companies. Like the sources mentioned, a fund might hold TCS and HDFC Bank, among others.
Exactly that. So if one company or sector doesn't do well, it doesn't sink your whole investment because it's spread out. It cushions the blow, reducing that overall risk the sources talk about.
Makes sense. The material also touches on different types of funds, just briefly.
Yeah, mainly equity funds. They focus on stocks aiming for growth, usually better for the long term, but, more volatile than debt funds. They invest in things like bonds, generally stabler, maybe for shorter goals, or if you're more risk averse. And it mentions hybrid funds, too, which mix both.
So for you listening, why do the sources really push mutual funds as a starting point?
Well, a few clear reasons emerge from the material. One, you get professional management. Experts are handling your research and decisions.
Takes the pressure off you.
Big time. Two, that automatic diversification we just talked about, built-in risk spreading.
Okay.
Three, they're accessible. The sources mention you can start small, like with just 500. You don't need a fortune.
That's a common misconception, isn't it? That you need lots of money.
It really is. And finally, simplicity. It's just, simpler than trying to build and manage your own portfolio of individual stocks from day one.
And speaking of simple and accessible, the sources really emphasize SIPs, systematic investment plans.
Yes. SIPs are presented as a fantastic way to invest, especially for beginners. It's basically investing a fixed amount regularly.
Like, say, euro 1,000 or maybe 5,000 every month, like the examples in the sources.
Exactly. Set it up and it happens automatically. The big benefit highlighted is something called rupee cost averaging.
Explain that a bit. How's that work for you?
Okay, so because you invest the same amount of money each time, you automatically buy more units of the fund when the price is low.
Because your fixed amount gets you more.
Right, and you buy fewer units when the price is high. Over time, especially with market ups and downs, this tends to average out the cost per unit you paid.
So it takes the guesswork and emotion out of trying to time the market.
Pretty much. It builds discipline, which the sources stress is crucial for long-term investing success.
Okay, so if someone's listening and thinking, right, I want to start based on this material, what's the first practical step?
The sources suggest a few things. First, figure out your goal. Why are you investing? What's the time frame? Second, assess your risk tolerance. How comfortable are you with potential dips?
Be honest with yourself there.
Absolutely. Third, do a little basic research. The sources mention resources like the AMFI website where you can look up fund details. And finally, the advice is clear. Start. Start small, maybe with an SIP, but start now.
Great. Let's just quickly recap the main points from the sources then.
Sure. The stock market is where companies grow, but it has risks. Mutual funds offer a way in for you, managed by pros, with built-in diversification to handle that risk.
And using an SIP is a smart, disciplined way to invest regularly and benefit from rupee cost averaging.
Exactly. You don't need to be some Wall Street guru to get started, especially with these tools.
The sources really make that clear. And maybe the final thought to leave you with, drawn from the material, is this view of investing.
Yeah, it's not a get-rich-quick scheme. It's framed as a marathon, not a sprint.
Right. And starting that marathon today, even with a small step, is probably the best thing the sources suggest you can do for your future self. It lets time do the heavy lifting.
Well said. Time is your biggest ally here.
Thanks for diving deep with us today.